Let's move on to the NewFunds GIVI RESI 15, and this offers investors a diversified exposure to 15 of the largest JSE-listed resource stocks, selected by intrinsic value and low volatility at lower costs. You're going to explain to us?
Yeah,
this is definitely some secret sauce going on in there. So GIVI is an acronym for Global Intrinsic Value Index. And in your intro, you correctly pointed out two aspects really that they focus on. What is the intrinsic value of the underlying stocks, but also excluding the highest volatility stocks. So about 30% of the stocks that fall into this universe get excluded because of share price volatility. So when we talk risk or volatility, very clear to be that this is about share.
How volatile do you have to be to get excluded?
So it's all relative. So you've got to be less volatile than 70% of the other stocks in this universe. And bear in mind that you can find when there's a strongly trending share price, that typically is low volatility. So it could be a high or an elevated level of share price, which in other terms, things like downside risk would certainly represent a higher risk. But the share price volatility is measured as being quite low because it's been trending.
Because it hasn't, I mean, it's stable. The share price is relatively stable.
That's exactly what it is.
But this system didn't just get invented overnight. I mean, S&P, which you were telling us, is the agency behind the GIVI.
Yes.
And that is a global equities rating and analytics business. So why did they come up with this? Did they find that this was a useful predictor that delivered excess alpha over time in the broader universe of stock selection?
Yes, and it's really a combination of those two things. So it's certainly trying to look for the value sort of aspect in terms of investments, but it also looks to reduce the volatility that would be associated with it. So it is a bit black boxy. It certainly has got some secret sauce going for it. It works very well at times, and at times it doesn't actually work particularly well. Very interesting for me is this is another one that's just pure what we would consider resources exposure, but very different resources companies than what we had in the Satrix RESI.
So give us a little colour around that.
Paper. It's all about paper. So Mondi and Sappi are by far the biggest weights really in terms of this index, and then the gold companies. So when you look at what's inside the GIVI RESI and you compare it to the Satrix RESI, it's almost chalk and cheese.
Are we saying then that the gold stocks haven't seen volatility in their share prices?
No, but they also represent value. So because of really the lack of performance from the gold price itself, we've actually seen gold companies relatively underperform, and I think that's why it gets picked up in this intrinsic value sort of methodology.
It's the two sides of the equation that you've got to take into consideration.
So if people are looking for nice broad-based exposure to resources through two ETFs, these two would actually be very complementary. So it is, I said, yes, I'm not hot on Satrix RESI, but I think if you combine it with the GIVI RESI, it could actually give you
well covered across the spectrum.
And you've got that low cost benefit and the diversification.
Given the big gold sector exposure, what's your outlook on the gold price? I mean, that in turn has seemed to march to its own different drum. It doesn't seem to be following any sense of kind of global risk associated with the Trump election. All of the scare stories about, what might happen and nuclear-related concerns and so on.
I think it could start.
It could, and I think what you're really seeing in terms of what's happened with the gold price over the 2 months since he was elected is really more reflective of risk on. So money coming back to the US, so not a need to actually sort of get that hedge and that safe bet of gold. Gold for me is, I don't really think of it as a commodity. For me, this is a currency rather than a commodity, and it certainly is unique. When you look at the other platinum group metals, platinum, palladium, rhodium, all of those really, they represent much more a commodity in the sense of the word of actually having an application in the economy, whereas gold doesn't really have it. So it's much more a financial instrument, a currency.
Financial instrument, you see, it's a currency. Nerina, we have one task this year, and that is to get Paul thinking of gold as a currency. Can we do that over the next 12-month period?
I'm with you.
Sorry, that was just a side conversation that we're going to have. All right, where are we now? So, do you want to ask any more questions on this one?
No, well, I was interested by your earlier observations that you might consider buying these two alongside each other. But why is that? Other than that you just like the idea of having a bit of this and a bit of that, and you don't like the underweighting of the one and the other.
So it's not so much a bit of this and a bit of that. For me, it is about getting the diversification, and neither of the two fully sort of captures the overall resources or commodity spectrum, and that's why I like them in combination.
If you combine them, you've got the full commodity spectrum. Then you're hot.
I do actually have one final question. I noticed that the NewFunds operation, I don't know if this is true of all of their funds, but they have very low total expense ratios. Which is admirable, because often these funds that have the so-called secret sauce, where somebody has a theory about what works over time, precisely attract a higher cost because somebody has to be paid for that smarts at the back. So is that a characteristic of S&P and their indexing?
I think it's of S&P. You've got it, hit the nail on the head there. So it's not so much a reflection of Absa, who've got the NewFunds brand, but rather S&P. So they have some of these so-called smart indices that don't come at a significantly higher price than your sort of more traditional indices.
But ETFs, generally speaking, are at a much more acceptable cost than your asset managers, your active asset managers.
So, you know, one can split hairs between 20 or 30 or 40 basis points with amongst the different ETFs, but you compare that to the 1.5–2% for the actively managed funds, and that's really where the big differentiation
comes in. Hot or not on the GIVI RESI 15?
So on its own, also not hot. I know, unfortunately, I don't have the choice of combining them and saying I'm hot, but I will just say it. I know it won't appear in the table.
We like your strategy. There's a bit of secret sauce in that formula in itself. Hot or not?
Yeah, I'm also going to go not hot. I mean, there may come a time when everything starts going up or blowing up, but for me at the moment, that combination of the core holdings doesn't sound terribly attractive. So I'm also going to